August 5th, 2024. Your AI portfolio dropped 10, 15, 20% in 72 hours. Every analyst on every channel said the same thing. AI valuations are too high, weak jobs report, recession fears. They were wrong. The actual cause was a single decision made in Tokyo by a central bank most Americans have never thought about once in their lives. And the signal that called it weeks before the crash wasn't an earnings miss, wasn't a Fed statement, wasn't anything you'd find on a standard finance channel. 3 letters, JPY USD. Stay with me because that signal is sitting at the same levels right now. And if you don't know what it means, the wrong story is going to cost you again. I'm not a financial advisor. Nothing here is financial advice. Numbers are as of filming. The crash had nothing to do with AI. It had everything to do with how AI gets funded. Once you understand the mechanism, you see it everywhere. I call it the funding layer. It sits underneath the entire AI infrastructure trade. Most retail investors don't know it exists. But it has been one of the most powerful forces moving growth portfolios for the last 3 years. Here's how it works. Japan has kept interest rates near zero for decades. Effectively free money if you know where to borrow it. The Bank of Japan held that policy for so long that entire institutional trading strategies were engineered on top of it. Institutions borrow in yen, collectively hundreds of billions of dollars worth, at near zero interest. They convert that yen into dollars. Then they take those dollars and buy the highest growth, highest return assets available. Right now, those assets are your AI infrastructure names. NVIDIA, Microsoft, Amazon, Broadcom, TSMC, Micron, the entire AI trade, the one you've been building your work optional portfolio around, is partly running on borrowed Japanese yen. This isn't a theory, it's a mechanical relationship that shows up in data every single time the yen moves significantly. As long as Japanese rates stay near zero and the yen stays weak, the math works perfectly. Borrow at zero, earn double-digit returns on AI infrastructure. Pocket the difference. But the moment that math breaks, the selling starts. Not because the company's changed, because the plumbing did. July 31st, 2024. Bank of Japan raises its policy rate from 0.1 to 0.25%. That sounds like nothing. For institutions running hundreds of billions in yen carry trades, it was an earthquake. The yen, which had been sitting near 160 per dollar, the weakest it had been in 40 years, started strengthening fast. In a matter of weeks, it moved from near 160 toward 142. That's more than a 10% move on one of the most heavily traded currency pairs on Earth. Picture a fund that's been running a $10 billion yen carry trade for 2 years. Borrowed yen at near zero, converted to dollars, deployed into NVIDIA and the hyperscalers. The trade has been printing. Returns are strong. Everything looks good on the position sheet. Then, in 1 week, the currency leg loses 10%. The math inverts. The position that was profitable is now underwater on the funding side. They don't hold. They don't wait for an earnings update to justify the exit. They unwind immediately and at scale. Multiply that by every institution running the same trade. That's what August 5th was. The Nikkei falls 12% in a single session. Worst single-day drop since Black Monday in 1987. The VIX, Wall Street's fear gauge, spikes to levels last seen during COVID. US markets open. The most crowded AI names follow. NVIDIA down double digits in days. The hyperscalers repriced in real time. Every position with carry trade funding behind it sold simultaneously without warning. And the headline said, recession fears, AI spending concerns, valuations. Not one mainstream story explained the carry trade. You didn't have bad stocks. You had the wrong story. Here's why this matters right now. The yen is sitting between 155 and 160 again, the same zone it was in before August 5th. The funding layer is under pressure, and the most crowded AI infrastructure names, the ones institutional money has piled into for 2 straight years, are sitting in the crosshairs. Not every name gets hit equally when this happens. The stocks that move first and hardest share a specific profile: extreme institutional ownership and high liquidity. The most crowded positions with the easiest exits. When funding gets called and institutions need to reduce exposure fast, they go where they can actually sell at scale. If you're holding AI infrastructure positions, this is the profile to know. These are not speculative names. These are the core holdings in most retail AI portfolios, which is exactly why understanding where the carry trade exposure sits matters more than most investors realize. The hyperscalers, Microsoft Azure, Amazon Web Services, Google Cloud, sit at the center of institutional AI positioning. These aren't just dominant businesses. They're the most heavily owned AI infrastructure names in the market. When carry trades unwind and institutions need to move size quickly, they go to the deepest liquidity first. That's the hyperscalers and some of the largest hardware names like NVIDIA and AMD. The correlation to sharp yen moves has been consistent across every major carry trade event. NVIDIA sits at the peak of institutional attention in this entire trade. The concentration of positioning is extreme. And when the carry trade unwinds, NVIDIA moves first, the biggest premium, the fastest reprice. That's the cost of being the most owned name in the most crowded AI trade on Earth. Broadcom has quietly become one of the most institutionally held names in custom silicon, with deep relationships at Alphabet and Meta on custom chip development. When hyperscaler positioning gets squeezed, Broadcom follows. That connection has been consistent. TSMC is the physical foundation of everything. Every AI chip, NVIDIA's, Broadcom's, the custom silicon running inside the hyperscalers runs through TSMC's fabs. There's no AI infrastructure trade without TSMC. When the funding layer cracks, TSMC carries the exposure with it. None of these businesses broke in August 2024. The fundamentals are intact. CapEx plans are intact. Customer relationships haven't changed. The funding structure underneath them wasn't. Knowing the difference between a business problem and a funding structure problem, that's the edge most retail investors don't have. So what do you actually watch? JPY USD. And here are the levels. Around 145, relative stability. Carry trades under less pressure. Liquidity flowing into risk assets normally. The macro signal is quiet. This is the environment where your AI names trade on fundamentals, not on funding fear. 150, this is the first warning signal. The Bank of Japan starts talking publicly about excessive volatility in currency markets. When USD JPY crosses 150, you start watching more closely. Not panicking, watching. You're paying attention to how fast the move is happening and whether Tokyo says anything. 155 to 160, the danger zone. This is where we are right now. Carry trades actively getting squeezed. Institutions reevaluating position sizing. The probability of forced selling is elevated. This is the zone where August 2024 started, 165 and above. Historically, this is where the most crowded growth trades have seen coordinated selling pressure. Without Bank of Japan intervention at this level, carry trade unwinds have become disorderly. But you're not just reading the number. A slow drift to 160 is different from a spike to 160. 160 with the BOJ making public noise, signaling they're watching, threatening to intervene, is different from 160 with silence out of Tokyo. You're reading three things simultaneously: the level, the velocity, and what Tokyo is saying. The level tells you the stress. The velocity tells you the urgency. Tokyo tells you whether someone's going to catch it before it gets disorderly. When all three are pointing the wrong direction at once, that's when your portfolio moves for reasons that have nothing to do with the businesses you own. The investors who understood August 2024 for what it actually was didn't panic. They watched the yen stabilize, watched the BOJ signal it was done, added to AI infrastructure positions at prices that looked terrifying in the moment, and obvious 3 months later. The market saw an AI crisis. They saw a funding structure correction on assets with intact fundamentals. That gap between what the narrative says and what the macro signal shows is exactly where the work optional portfolio gets built. My newsletter isn't a stock breakdown. It's how I use first principles to spot the structural shifts moving market and the company's position to benefit. If that's the lens you want, links in the description. JPY USD, add it to your dashboard. Learn the levels. Watch the velocity. The signal was always there. Now you know how to read it.